Which is more profitable, a property with a 5% tax or one with a 20% tax? If you answered 5, you've fallen into a trap. Half of the real estate agents are now saying in unison the tax on hotels and apartments has increased while it's lower for apartments in Georgia. Buy apartments immediately, but they are only comparing the two rates. And in order to pay tax on profit, you first need to earn that profit. You shouldn't look at the tax percentage, but at how much money you actually have left in your hands in the end. Let's take a hotel room unit for 80,000 euros with a yield of 17% per annum. The income is 13,600 euros per year. Minus 20% tax, that's 2,720 euros. Minus 1% property tax, 800 euros. Minus the building fee of 240 euros per year. You're left with about 9,840 euros. The net yield is 12.3% per annum after taxes. And notice, you didn't lift a finger for this. While the room is being rented out, occupied, cleaned, and maintained, you can be in another country and not even think about it at all. Now, a 1+1 apartment for $100,000. We rent it out for $500 a month, which is $6,000 a year. Minus the management fee of 10%, $600. Minus the 5% tax, $300. Minus the building fee, $900. Minus property tax, $1,000 and at least $500 a year for repairs and breakdowns. That leaves about $2,700. The net yield is 2.7% per annum. And that's if the apartment stays occupied for all 12 months without a single vacancy. Look at what happened. You were scared of the 20% tax, but you got 12.3% per annum net. You were happy about the 5% tax, but you got 2.7% per annum. The difference in money is significant. And that's not all. You have to buy the apartment, renovate it, find a tenant, fix appliances, and deal with issues with the residents. Even if an agent handles this, they still come to you for most issues. In a hotel project with an international management company, you don't get involved in operations at all. In some models, the management company even covers taxes and you receive net income. So don't choose a property based on the principle of 5% here, 20% there. First, calculate how much it actually earns, then subtract all expenses and only then compare. Because 5% tax on a small profit will leave you with less money than 20% on a truly profitable property. Save this video so you don't lose the calculation.